Todd Uzzell here. I get a lot of questions about how much can I afford, how much money do I need to make to buy X house. So I put a couple of calculators together. One's going to show the affordability, which is how much can I afford based on what I make today. The reverse will show how much do I need in order to buy a house that's X price. And the rent versus buy will show the value of renting versus buying. And I even put another piece in there. I'll get to it, but let's start with the affordability calculator. So you come down here, you drop your monthly gross income. You know, if you make $96,000 a year, you're going to make about $8,000 a month. So we're going to take that and put it in there. And if you're doing it with a spouse or somebody else, you know, you're going to add those two monthly incomes together. Monthly debts is going to be like car payments, credit cards, student loans. Anything that's going to show up on your credit report would be considered a monthly debt payment. For this example, we're going to throw $1,000 in there. So it could be a $1,000 car payment, it could be a $500 car payment with $500 in credit cards. Interest rate, today's rates, we're going to say 7, could be 6.5, but you can always tinker with this and see what kind of a difference it makes. Standard loan term is 30 years. Estimated taxes and insurance. This is going to include property taxes, homeowners insurance, and mortgage insurance, assuming you're not putting 20% down. And for this example, we will not be. $500 is pretty close. Like I said, it might be $400, it might be $600, depending on where you live or what homeowners insurance you have, things like that. But for this example, $500 is going to be a pretty good number. We're going to put the minimum 3% down for a conventional loan. And this says that our maximum monthly house payment, which is going to be based on the 45% of your total income, more or less. So you have principal and interest, $2,500 plus the $500 for tax and insurance leaves a $3,000 house payment. And in this market, a $3,000 house payment is going to buy you somewhere in the neighborhood of a $387,000 house. So again, if we came and changed this, say we went to 6.5, well, that goes up to 407. So you play with this just to kind of see what makes the most sense. If you make more money, do that. If you have less debts, that's going to make a difference too. If we only had $500 worth of debts at 6.5, now we're almost $500,000. So it's just really easy to plug and play here once you kind of have an understanding what these numbers mean. I hope I explained it well. If not, you can always contact me, of course. But let's move on to the reverse calculator. So this says if I want a house of X price, how much money do I need to make? So let's say $450,000. We'll go 7% interest again, standard 30-year loan term. Again, $500 for the property taxes and insurance is pretty typical, at least here in Arizona. You go to a place like Texas or somewhere where the property taxes are higher, that would be different. But we can always figure that out. And we'll go minimum down 3%, monthly debts, $1,000. So if you had all these things, $1,000 in monthly debts, we're doing conventional at max 50%. I'll throw an FHA in there because that will work too. But you're looking at a principal and interest payment of $2,900 plus $500 for the taxes and insurance. So you can buy a $436,000 house under, well, our $450,000 house with 3% down. You need to make about $9,700 a month. So if we went FHA, that's going to change this a little bit because we can stretch this debt to income ratio. That means this number is less punitive. So now, same monthly payment, we're looking at $7,800 a month. So as you can see, FHA makes a difference. There's a couple upsides and downsides to FHA, but the biggest difference between FHA and conventional, assuming you're not, again, putting 20% down, is the upfront mortgage insurance. For all FHA loans, they're going to have an upfront mortgage insurance, which is generally rolled into the loan of 1.75. So for a $450,000 house, that's going to be roughly $10,000 that's additional to your loan. So instead of your loan looking like, in this case, $436, it would look like $446. Wouldn't change the payment a lot, but that's something to think about. And, we always give you both options when we're running through. After you've done an application, we'll give you both options so you can kind of see what makes the most sense. So let's move on to the rent versus buy calculator. So this is where you're going to put your monthly rent in. Say you pay $2,500 a month for rent. Too many. We're going to assume an annual increase of 2% rent, which is probably about right. And you want to buy a house, we'll stay on the $450,000. Down payment percentage, stay with 3%. Annual interest, we'll go with 7. Loan term, 30-year standard. $500 for tax and insurance. Again, we're going to say typical Arizona home appreciation is 3%. Could be more. but we're going to be conservative for this calculation, and we're going to push a time horizon out of 5 years. So we're going to assume if we rented or if we own for the next 5 years, what does that look like? So here we have total rent costs. So you're going to pay $2,500 a month for essentially 60 months, and this is the number you're going to come up with. If we bought, our down payment plus our monthly payments, which are right here, $3,400 for a $450,000 house, would be just over $217,000. And the equity, based on a 3% increase on a $450,000 house, would be about 85 grand. So after 5 years, this is assuming your house would be worth somewhere in the neighborhood of 530, 540,000. And now I wanted to put this in because it's a nice concept. Most people that are paying $2,500 wouldn't necessarily take the difference, which would be about $900, and invest it. But if you did, at a rate of 8% over 5 years, that $900 a month would have netted you about $66,000. Of course, this doesn't take into consider tax implications or anything like that. But I like to put this in here because I do work with a lot of financial advisors, and if for some reason someone was like, well, I don't really want to buy, well, let's talk to a financial advisor and see if investing makes sense. And 8% is pretty conservative. You might go 10 or 12 depending on the advisor and depending on the market. But I put these three together. I thought they would be just something nice to kind of help you understand how much you could buy or how much it would cost you to buy. And then, of course, the rent versus buy is another interesting way to just look at purchasing a home. I hope this helps. All my contact information is up here. If you like to apply to see where you stand, we do a soft pull at the beginning, so there's no hard inquiry on your credit. If you need to work on your credit, we can help with that as well. And if you just want to schedule a consultation, click here and get on my calendar, and we'll go from there. But once again, hope this helps. My name is Todd Uzzell. I'm a mortgage loan officer. Hope you have a great day.